I don't answer to the bank anymore because I took back control of my money. I took back the banking function in my life. We change where our money goes first. We put our money in a specially designed and engineered whole life policy, and then we immediately move the money out. And you guys are private lenders, and we lend the money out. We buy real estate. We've lost no control of our money, zero control of our money.
So we did nothing different except where the money goes first?
We use whole life because it is the only product in the world that can do what I just showed you with guarantees. This whole life policy, which every year goes up in value. Gold goes up, goes down, goes up, go down. This never goes anywhere but up. Good afternoon. This is the holiday and Christmas special because it is the last wealth webinar before Christmas. And all of you are here. I'm so honored to have 115 people right before Christmas. Some of you might be hopped up on eggnog, but that's okay. This is going to be super fun. I was pretty, taken back to see that we actually have a bunch of new members on here, a bunch of new viewers for the first time. They are called AI. I don't know who they are. I'm going to talk to them throughout, though. They seem really smart. So if any of you know AI, make an introduction to one of us, get them on, a call, have them watch the 90-minute video, and we'll be happy to answer all their questions. So
maybe that's Santa's trick over the years. He uses AI to deliver all these presents. Santa.
Yeah, so to all of our brand new AI members, welcome to the Wealth Webinar. And to the rest of you, welcome back. Or for the, just over in the chat, let's check the audience here. How many of you are here for the very first time? This is your first Wealth Webinar you've ever attended. Put new in the chat. Let's just kind of check this out. We got Zach. Welcome, Zach. We got Justin, Brian, Steven. We got Steven. Tammy's new. We got Tony, Kathy, Robert, second time. Thanks for coming back. And then we got all of our AI friends that are here. Okay, wonderful. And for the rest of you, thanks for joining us again. So listen, here's what we're going to cover today. We're going to cover a couple different things, but we're always talking about being your own bank. We're talking about how you can be the bank, how you can take back control of your money. And listen, I'll say the same thing I say every single week and in every video. There isn't a better time ever in any of your lives than right now to become your own bank, given the economic uncertainties, given everything that's going on, given what the dude's doing, given what Jerome Powell is saying, which is stupid, just not a good idea to sit there and make things, or say things like we're going to drop rates, or we might drop rates, or we might keep the door open. Like it was even said by many people like, oh, we're not talking about that in the Fed, but yet Jerome Powell just put it out there in the open, rallied the markets to all-time highs. Anyway, the one thing I want to tell you is this is the moment. And I'm going to prove it today. I'm going to prove why you shouldn't keep money in traditional banks. You're always going to have money in traditional banks, but you shouldn't keep a lot. You should keep your emergency fund, the money to pay your groceries, your rent, your utilities. But the one thing I always say is there's a better place to store your wealth. Not the permanent place, not the 401k, not the IRA. I'm talking about the place where you put the money that you might need for the next investment, the next real estate deal, the next loan, that money. All we're going to do is we're going to talk about changing just one thing. And that is where your money goes first. That's it. Not where the money goes first and stays. We don't want to leave our money anywhere. We don't want to park our money somewhere and just be like, oh, I'm just going to leave it there. My job's done. No, your job is never going to be done because your job is to keep your money working for you. Because listen, there's 24 hours in the day, folks. All of us have the same exact amount of hours in a day. We got to sleep, we got to eat, we got to use the restroom, we got to entertain, we got to do all sorts of things in that 24 hours. So there's so few hours that we have to spend on working for money. But yet that's what we've been told to do our entire life. We've been told to go out and get a job, begin a career, go to college so you can get a better career, start your business. And then what do most of us do? Not all of us, because some of us have kind of gotten off that little treadwheel. But we trade our hours for dollars. Think about it. Your whole life, you've always kind of had ideas in your mind of how much you think you're worth an hour. I remember back when I worked on a farm at 14 years old, I got paid $3.75 an hour. That was my worth, or at least that's what they told me it was. Then when I went to 5, I'm like, oh man, I'm making $5 an hour. And then it went up from there. then it was 7, then it was 10. And does anyone remember when, some of you are older than I am or about the same age, 46? You remember when you started making $10 an hour? That was like, to me, a monumental mark. It was like, holy crap, mom, I'm making $10 an hour. And now today it's like 20 bucks an hour, whatever it is. But you put a value on your time based on not what you think your time's worth. Because if you actually had to value your time, let me ask this. Everybody that's on here in the chat, put down how much your hour is worth to you. Put it down right now. How much is your hour worth to you? I'm going to stop right there. Teresa nailed it. It's priceless. Priceless. There's no other answer I should get when I ask that question. Your hours cannot be valued because you can never get them back. Money, we can always make more money. Money is there's so much of it out there. There's more than any of us can ever use in our lifetimes. So money isn't the issue, but time is. So everything I'm going to teach you when it comes to becoming your own bank, when it comes to taking back control of your money, the one thing I'm telling you how to do is get time back. And the only way I know possible to get time back is to allow your money to work for you, because your money doesn't fall under the same rules you and I do. Your money doesn't need breaks, doesn't need bathroom breaks, doesn't need vacation breaks, doesn't take Christmas off, does not stop. Your money can work 24/7 and will and wants to if you know how to make your money work for you. So by changing where your money goes first, what I'm going to do is give you the first step to having your money work for you 24/7, never stopping. And we're going to call that compounding interest. But we're going to add a word to compound interest because we all know what compound interest is. We take the money we earn, we put it somewhere where it earns a rate of return, and we leave it there, and that money compounds. And the next year, whatever interest or gains it has, that money now is earning the same interest rate. And it's compounding over and over. And over time, it gets bigger and bigger and bigger, and the velocity of money hits it, right? You all know what compound interest is. But let me ask you this. If I take my money and I put it in a 401k or I put it in a bank account, now it's in the bank account. It's earning interest. It's compounding. But now Stephen needs a loan for 12%. I take the money out of the bank and I give it to Stephen. Okay, I took all of it. There's nothing left in the bank or whatever account it is. Let me ask you a question. Stephen has my money. He's paying me interest. How much is the bank paying me? How much is your 401k paying you when you took the money out? Nothing, right? Nothing. The bank will not allow your money to work for you when you take the money out of the bank to make it go to work for you at a higher rate. It stops the compounding. But what if there was a place where you could put that money, have it earn compound interest, take that money out, but actually your money never leaves. So your money continues to earn uninterrupted compounding interest while your money then goes to someone like Stephen, who then pays you interest a second time. Doesn't that sound like a better plan? Well, it should, because that's exactly what a bank does. See, here's how a traditional bank operates. This is a bank. Okay, right here, right in front of you. This is how a bank works. We put money in the bank. Remember, we put the money in the bank. The bank pays us interest, 4%. The bank then lends our money out and makes higher interest rates. They lend it on homes, on cars, on home remodels and debt consolidation loans. But the money that we gave the bank has to sit there in order for the bank to do this, right? So we get paid 4, the bank gets paid how much? Well, if we add the spread up, 20. The bank gets to make your money work for you. Now, I want you to be the bank. I want you to be able to have your money work for you twice, not just at the 4% rate, but I want you to make the 4% plus the spread. I want you to make the 4% plus the 4. I want you to make the 4% plus the 5 plus the 8. I want you to make the 20% that the bank, the traditional bank, is making today. But in order to do that, folks, we have to change where your money, your savings, not all your money, just the money that you would save for bigger purchases or investments, where that money goes first. Because I want you to earn uninterrupted compounding interest. So you might be asking yourself, well, Chris, that just sounds that sounds awesome. That would be like Christmas every single day, right? But there's no place like that exists. Or is there a place like that? This is called the money multiplier method. That's our company, the money multiplier. And what we're doing is we're calling this the money multiplier method, because that's all it is. It's a method. It's a process. We need a machine. Because if I've already told you we can't use a traditional bank, we can't use Wall Street accounts, definitely can't use 401ks in this capacity, we need a place that we can put our money, a machine that we could run our money through where it will pay us uninterrupted compounding interest, because I'm trying to get you time back. In order to get you time back, what must happen? Everybody in the chat, in order for you to get time back, what must happen? Money must work for you. Exactly. So we need a machine to put our money in, or I like to say, run our money through, where we can have our money work for us 24 hours a day, 7 days a week, without any interruption. So the first part of the money multiplier method is the machine. The second component to the money multiplier method is this. Everybody hates this, the marathon. What I'm going to teach you is a process, but we're really going to focus on today just the first part of the process, which is the machine. Now, the whole webinar, I'm going to dive into the machine, because we always talk about the process, the infinite banking concept, be your own bank. But today we're really going to focus on the machine. But after the machine, after you put the money through the machine, you have to understand, in order for this to work, in order for compounding interest to work, you need to understand that it does take time. I'm going to get you time back. But to get you time back, you have to understand there's no get rich quick thing here. This isn't some magical thing where you flip a light switch and all of a sudden you're wealthy. This is going to take time, and we're going to go over how much time it takes. For each of you, it will be different, but you will see that it's not long, but it is a marathon. Life is a marathon. Okay, it's not a sprint. If you sprint through life, you miss a whole lot. You don't stop and smell the roses, because sprinting comes with people that are rushing, people that haven't learned how to get their time back. That isn't you. This is a marathon. Lastly, and I think most importantly, none of this works unless you have a goal, a worthy idea. And I'm going to give you guys all a challenge. My entire team has been we started on 6 days ago. We started on a 30-day challenge. I'm going to give all of you a 30-day challenge today. Whether you choose to accept that challenge is up to you. But if I can tell you this, if I can tell you that in 30 days, I will change your entire mindset and your life, would you take the challenge? In the chat, if I could tell you that by watching one video every day, I know that sounds monotonous, it's 28 minutes long, every morning or whenever you have that 28 minutes for you set it, you wake up 28 minutes early and you watch a video every day for 30 days. Okay, that's the challenge. You watch this video every day for 30 days. But I can promise you that if you do that every day for 30 straight days, in 31 days, I promise your mindset will be changed, and I promise your life will begin to change. You need to understand what the strangest secret in the world is. So that's going to be the challenge, okay? Yep, Tess is already on it's day 6 now. So this here, the millionaire, that's your destination. That's your goal. That's your worthy idea. You need to have a goal. Because if you don't have a goal, it doesn't matter what the machine can do for you. It doesn't matter what the marathon does for you. Without the goal, none of this matters. So let's go to the next one. See this? That's quite the machine, huh? Any of you ever driven a car with an engine like that? And don't tell me, the AI folks on here, I guarantee they're going to tell me they're driving Teslas. But your Tesla doesn't roar like this machine right here does, okay? So we're going to change one thing, and that is where your money goes first. And your money's going to go into a machine, but it is not going to stay in the machine. It's going to run through the machine. Think of it as a processing machine. All it's going to do is your money goes into it, and we're going to find a way to get that money back out of it into a better place where your worthy idea starts to take shape. So we're going to run our money through this machine. That's it. But when we run our money through this machine, it's kind of like Monopoly. I want you to think of Monopoly. Every time you pass go, you get paid, right? $200 for pass and go every single time. The machine, we're going to say pass and go is every year. Every year, the machine does the same thing the Monopoly board does. When you pass go, when you go past your policy year, you get paid. Okay, pretty cool, right? So that's what I want you to think of it. So what is this machine for those of you here for the first time? Boring. It is a dividend paying whole life insurance policy from a mutually owned company. Now I'm going to watch the numbers. We got 136. Steven, almost every time I tell people what the machine is, we lose people. Yep. See, look at that. Two. We got 2 of them are gone. Probably 2 AIs gone. I told them it's a whole life insurance policy. And no matter what else I tell them, the blinders come on and they don't want to hear anything else. We lost 2 and we got 1 back. That's interesting because they were probably still listening and they're like, oh, all right, well, but listen here. I'm not going to tell you anything else, but I'm going to tell you, I want you to remember this. The problem with most people is not what they don't know. The problem with most people is what they think that they know that just ain't so, including Cashy here. You see, I just told you what this magic machine was that I built you up that allows you to earn uninterrupted compounding interest on a tax-free basis, allows you to use your money anytime without any restrictions, except for you're not going to be able to use all of the money in the beginning. The money that goes through this machine, the specially designed whole life, is protected from judgments and liens in most states. And someday when you graduate and go on to a better place, your machine, this whole life policy, will pay a death benefit tax-free to your family. Those are just the baseline reasons we use a whole life. But you know what? That's usually not convincing enough. So what I'm going to do today is I'm going to break down my machines. I'm going to break down my whole life policies. Yep. And I'm going to show you how, and I'm actually going to show you why banks are the .1 purchasers of whole life insurance in the world. It's known as BOLI. Okay, you can look BOLI up and you'll see the same thing I do right here. Here's the source, FDIC.gov. I like to give you factual stuff. We're in a fact-checking kind of world. So there it is, FDIC.gov, type in BOLI. You will get a list of all the banks, Bank of America, Wells Fargo, JP Morgan Chase, US Bank, PNC Bank. You'll get a list of all the banks, not just the top 5, and they will show you how much money they have in BOLI, bank-owned life insurance, which is whole life every single time. $75,808,415,000 as of 2021. This is old. So that's what you're going to see. Now, let me ask you this, folks. Do you think the banks are buying the same whole life that your advisor or your brother-in-law tried selling you? No. But what's the difference? Well, you would probably think that banks probably design them differently, right? Design and engineer them to be more lucrative. Maybe don't pay as much in commissions to that agent because the bank wants to keep most of the money, because banks are what? For the most part, greedy. So banks are greedy, so they don't want the agent to get paid a bunch, so they're going to strip the commission out, and they're going to build the policy so that it's got a lot more value for the bank, right? Sounds like a worthy cause for the bank. If the banks can design and engineer a whole life insurance policy for their use, do you think we can do pretty much the same thing? The answer is yes. So for anyone that was thinking whole life is a terrible place you should put your money, Dave Ramsey said that it's the worst place you could ever put your money. I will, by the end of this video, by the end of this webinar, prove them wrong. Mathematically and without any, nobody will be able to contest that a whole life is a great place to put their money. Why? Well, because I've got 3 whole life policies that I own sitting in front of me. And you know what the cool part about these 3 machines, these 3 whole life policies? They're all different. They're all different. You see this one here, boom. Okay, I'll put it close so you can guys see I'm not making this up. I know it's a bit blurry. What does that say at the top right over here? This one right here. What's the name of that company?
New York Life.
Yes, New York Life. And if you could see down here, what year, whoops, there it is. What year did I start this policy? December. Might be hard to see. I'll just tell you. December 1st, 2014. You know what's unique about this policy? This is an off-the-shelf whole life insurance policy. Very different than the one the banks do. Very different than the ones we would do for you today. This is a normal off-the-shelf whole life. At Thanksgiving, when your brother-in-law sat down with you, they just started an insurance company and they're trying to sell you a whole life policy. This is one of those. It's an off-the-shelf whole life insurance policy. Nothing exciting about it at all. I'm going to show you the numbers, okay? Because, hey, listen, like we design and engineer whole life policies to be used for the infinite banking concept, to maximize cash value in the early years. What sucks about this policy is in the first year, I put in $6,466. How much money do you think I had in cash value to use in that first year? Does anyone know? How much do you think I had, Stephen?
Probably 0.
Zero, correct. Absolutely zero. So this policy, the year I started it, 2014, had zero cash value. How many of you want a whole life policy that has zero cash value to use the first year? How many of you? Zero, right? This one had zero cash value in year one. But this isn't year one. This is the marathon. This is the normal whole life. Now, nothing that we would ever do for you, but I just want to fast forward. I'm going to go to 2021, okay? So here's what we're going to do. I'm going to give you actual numbers off 3 years of this right to current, and I want you guys to pay attention. So 2021, how many years is it from 2014 to 2021? Is that 7 years? That's the marathon I had to go through. If I did the math right, 7 years. I had to wait 7 years to get to the point of this with this policy. So I technically lost opportunity in those 7 years. But let's go through that, all right? The premium that I put into this policy, so let's get that out of the way. I do this monthly at $570.21, but each year I put in $6,466. Everybody's got that. $6,466 is my premium. My cash value in the 7th year, my cash value was $39,000. That's the cash value, okay? I got $39,000 bucks. So hold on. I know some of you are already doing the math, but AI, you guys probably already have this figured out. Let's figure this out. So 6,466 times 7 years. I put in, so my cost basis is $45,262. Okay, that's how much money I put into this policy. So you can see I've still put more money into the policy than I have. But hold on. You're probably thinking that's a terrible place to put your money, but this is a regular off-the-shelf whole life. If I die tomorrow, it's worth $218,000. Well, in 2021, it was worth $218, and that's worthy of putting up here. $218,998 is the death benefit, 7 years in. So no one's excited at this point, right? Not a cool place to put money. Not even broken even after 7 years. What in the world did I sign up for to come to this webinar? Well, here. What if, just what if I took this $39,000 out? I took it out as a loan. And I lend that money out over here. Hey, does anyone on here need some money? Anyone need 39 grand? I got to take her for 39,000 bucks. Anyone? 12%. Anna, you good at 12%? Oh, don't like 12%. Does anyone want 39,000 at 12%? Mary will take 39,000 bucks at 12%. This is very important, so pay attention. So I'm going to take $39,000 out of the policy, and I'm going to lend that out at 12%. So Mary is going to pay me $4,680, but she's going to pay me monthly. So every single month, I'm going to make $390 a month. Got it? 12% gets me $390 a month for the $39,000. Now, coming back over here, nobody was excited about that because you guys, I'm tricking you, but you don't know that yet because I gave you the cumulative return and you said 45,000 was put in, but I only have $39,000 in there. That's crappy. Okay, let me keep going. This year, my guaranteed cash value interest growth, okay, so this is how much interest I earned on this policy, was $5,974. Just want to make sure everybody knows that I'm not making this up. Can you guys all see that? Right there, top line. Okay, but then whole life policies pay you money twice. They pay you guaranteed interest contractually. It never changes. This policy, if I'm not mistaken, was 4%. So I earn 4% guaranteed interest. This is one of those good ones, the old ones, where we got 4%. Guaranteed interest worked out to be $5,974. But every single year, this company also paid me a dividend. And this year, my dividend was $1,294.77. So if I add those two up, I made $7,068.77. Okay. Now you got the numbers, right? Let's just do the math. I earned $7,268.77. How much money did I put into the policy? $6,466. So let's do some quick math here. Now let's subtract how much I put in that year, because I want to know the same thing all of you want to know when you look at your 401k statement. I want to know how much money I made on my money this year. I put $6,466 in. I made $7,268.77 net. What do I mean? Net of commissions, net of policy service fee, net of cost of insurance. Because this cost of insurance this is my death benefit. That costs money. That's my net. So I made $802.77. That's how much money I made this year, okay, in 2021. So we're talking 2024. If I made $802.77 net, and I want to know my return on my money that year, called cash on cash return, I would take this 802 and I would divide it into the amount that I put in. What does that work out to be? 12.44%. So my cash on cash return, I'll just put my return, was 12%. How many of you right now can have a place where you can put money where most all of the money is guaranteed that earns 12.44%? Does anyone have a place like that? Anyone? Probably not. Matter of fact, I don't know of any other place that could do something like this. Cash, you're in the way. So I made 12.44%. Now, hold on. I didn't make 12.44%. I made 12.44% this year in 2021, plus I made 12% here. So I made 12.44 plus Mary paid me 12%. So what did I make? I made technically 24.44%, but I'm not giving you the whole picture. When I took the loan from the policy, the insurance company gave me $39,000 of my death benefit while I'm living. So literally, that loan, the insurance company subtracted $39,000 from my death benefit, and they gave me part of that death benefit from their general account while I'm living. That was not free. The loan interest, we'll just say 5%. Might have even been 4 back then. But let's just round up and we'll say it was 5%. So I subtract 5%. That stupid insurance company charged me interest on that loan that I took from my own money. Those bastards. I mean, how dare they charge me interest on my own money? Because really it is your money, right? You put $45,000 in, of which you got $39,872 of cash value, that you then took $39,000 out. So you're just taking your money back. So how much did you make? Well, you made 5% less. So you made 19.44% that year net on your money. Is anyone upset that they made 19.44%? Anyone upset about that? Does everybody understand how that worked? You see, and I said this early on, when I took the $39,000 out, where did I take it from? Did I take it from my cash value like you do in a bank? Remember I said if you put 39 grand in a bank and you take 39 grand out and I give it to Mary, the bank pays me nothing on that 39 grand because my money stops earning compound interest. In the policy, I didn't take my money. I used part of my death benefit, which the insurance company allows you 100% of the time to do this. As long as you got cash value, you can take your death benefit. I took my death benefit out, which then allowed me to earn money a second time. So I made money twice. I made money right here, guaranteed cash value interest and dividends. I already gave you that, 12.44%, plus I made 12% by lending the money to Mary. The only thing I had to pay the insurance company was 5% simple interest. But here's the thing, I'm smart. So I'm going to take this $390 that Mary gives me, and I'm going to take it and I'm going to use it to repay that loan every single month. So every single month, I'm going to take that interest that Mary paid me, which is money that my money was able to earn, and I'm going to use that to pay the loan down. So here's what I want to do. Is everybody tracking with me? Everybody following this? I know Stephen's answering questions. Stephen, did any questions come up I need to stop and address at this point?
No, we're good right now. Okay,
so folks, because I'm going to go faster. I'm just painting the picture here, and then after this, we're going to go faster and faster. Okay, so right here. This is a calculator that Craig Yenny on our team that came up with. $39,000 was the loan we took from the insurance company. The insurance company charges us 5%. So you can see that. I got to change this to 39,000. There we go. Okay, and then how much does that work out to be? Well, here, I can actually just do it on this other one. So what I'm going to show here is all I'm going to do is I'm going to show that I took a loan for my policy of 39 grand. I'm going to take the interest Mary's paying me of $390 a month. And all I'm going to do is I'm not going to put it in a traditional bank. I'm going to put it back in the policy as a loan repayment. Now, here's something that's important to understand. Every time I take this $390 that Mary gave me and put it back into the policy as a loan repayment, how much money do I have the next day when the check clears? $390. So I'm not losing the ability to use this $390. Whether the $390 went into a bank account or into the policy, I still have $390 to use when that check clears. Everybody's clear about that, right? But the reason I'm going to always put it back in my policy is because I'm the bank now. I don't want to use their bank. I don't want them to have $390 to use. I am the bank. I want to benefit. I want to be the bank. So I put the $390 back in. Now, what that does is that repays the loan to the insurance company, but it also reduces my principal balance to the insurance company, which what it also does is reduces the interest that I'm giving to the insurance company. If I started at 5% and I all of a sudden now paid $390, I'm down to 3.5 or 4.95, then 4.9. And by the end of the year, I only paid the insurance company 4.67%. Okay, everybody sees what happens there, because the insurance company charges me simple interest on the loan, but my money's compounding. So because I'm paying the insurance company back, I'm actually paying them less and less interest every time I put that $390 back into the policy, and I still have $390 to use. Everybody understood that so far, right? That's the process. We put money into the machine the whole life. We take the money out. We make it go to work. I showed you lending money to Mary. We take the interest Mary does give us, or whatever that money is that we earn, and we put it back into the policy as a loan repayment. We've lost no control of our money, zero control of our money. We still have 100% of that $390. I've already netted out the insurance cost, or I've netted the insurance cost. I've netted the commissions. I've netted the policy and policy service charge. And I also even netted the 5% simple interest they charge us on that loan. Okay, that was 2020. Now what we're going to do is we're going to go really fast, and we're going to go year by year, but I want to show you how these numbers change. And I want you all to remember that what I'm showing you here is a standard off-the-shelf whole life insurance policy. I'm not showing you the ones we build. Here we go, round 2, 2022. Same policy. How much is my cash value now? All right, my cash value this period, 2022, is now $47,778.47. My death benefit has gone up. My death benefit is now $224,174. Okay, that's my death benefit. And how much money did I put into the policy? Let's see, I got $6,466. We are now in our 8th year times 8, 51,000. So I got 51,728. But you see, we don't care about this. We don't care about how much we put in versus how much we can use, because we're still able to make more money because we can take 47,000 out and lend it to Mary again. I can continually take the money out and not interrupt the cash, the accumulation, the compounding. So here we go. Here's the math. My guaranteed cash value increase is $6,184. My dividend that I earned this year is $1,537.10. Total is $7,721. Subtract the $64.66, which is my premium. How much did I make now? $1,255. Last year I made $800. So if I take $1,255, my net gain, and I divide it into my premium, what was my cash on cash return? 19%. Stephen, how much was it last time? 12.44. 1 year later, nothing changed. I didn't put more money in. I didn't take on any more risk. I didn't go out and work any harder. I'm saving the same amount of money, and my return is now 19%. So now when we went over here and we did the math, instead of 24, now what we do is we put 19% here. So now you can see how my numbers went up. I didn't make 24% anymore. I made, hold on, 32. Sorry, I'm doing this quick. So now 32 minus 5, my return went up. I'm just doing this quick, folks. Don't get on me about the numbers. I'm just trying to show you how this works. 2022, hold on, let's move on. One more year. We'll come up to the current year, 2023, right there. Whoops. If anyone can see that, 2023. 9 years. Had this stupid policy, stupid whole life. Should have listened to Dave Ramsey, right? I'm in the 9th year. Never put more money in. How much is my cash value in the 9th year? $56,070. This is being recorded. We will put this up on our YouTube channel so you guys can watch and do all the math. My death benefit is now $229,533. My guaranteed cash value is $6,406. That's the increase. My dividend is no longer $1,500. It's now $1,644.69. My total that I made is now $8,050.69. Subtract the premium. And what did I make? Okay, I made a net of $1,584.69. Divided into the premium, what is my cash on cash return? 24.5%. 3 years in a standard off-the-shelf whole life. Now 19 goes to 24, 32 goes 4, 5, 6 to 36 minus 5. My return was 31%. I made money twice, folks. I hope that a little bit drawn out and long process that I just walked you through showed you, like, this is why the wealthiest families in history have used whole life insurance. That's why we use it. That's why we don't use index universal life. It's why we don't use universal life. It's why we don't use a bank account, why we don't use a CD. We use whole life because it is the only product in the world that can do what I just showed you with guarantees. With guarantees. You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up. Stephen, if you could you do me a huge favor? You know that illustration you have showing a policy designed and engineered properly, and you kind of show the returns on that? Would you mind just pulling that up? Are there any good questions coming in? Did you guys like that? I've never shown that. I have YouTube videos that did something, similar, but I've never done it like that. And earlier today, there's so much talk about the product. I was on a radio show last night. I told them what we do is we teach a process called the infinite banking concept. We teach people how to become the bank and take back control. And they're like, oh, wow, great. What does it look like? I said, well, we change where our money goes first. We put our money in a specially designed and engineered whole life policy. And then we immediately move the money out. And you guys are private lenders and we lend the money out. We buy real estate. And they're like, the whole rest of that 26-minute radio show, the only thing these four guys wanted to talk about is the product, which is what got me the idea of today just talking about the product. Why? Because the product is what you can sink your teeth into. It's what you know. It's what you probably hate or think you hate because you don't know what you don't know. The whole life policy. Stephen, you want to explain this one? This is a properly designed and engineered whole life insurance policy that we did for a client. And this one that Stephen's going to show you has cash value to use in the first year. And I'll let Stephen take it from there.
Yeah, I mean, so this is a policy that is in force of an actual client from a couple of years ago, just as an example here. So this was a 41-year-old female, and she wanted to put in $150,000 up front and then do $50,000 a year starting in year 2 moving forward. So you can see how we build these, we can get a larger amount in. Now, I mean, we probably could have got up to $500,000 in this thing up front if we really wanted to max out the dump in up front. So we have some pretty good range of flexibility in the front end of how we can front load these things. So if you look over, let me do annotate here. Okay, so if you look over at the increase in net cash value column that I'm highlighting, you can see the cash value is the amount available for loans, essentially. So you can see in year 1, when she puts in $150,000, she has about $132,000 available to pull out via a loan. So I have to do the math on that. So if I take, let's see, so if we do the math on that, we take $132,000 $538 in cash value, divide that by the 150 that we took to put in it. So it's about 88.3% cash value available in year one compared to the premium deposit that was paid into it. So not bad. And we can even tweak these where, depending on if we play to dump in a little bit and stuff, we can sometimes get them even over 90%. So, most policies, whether you have a dump in or not, depending on a couple other factors, you're going to have anywhere from 60 to 90% cash value available in year one. So this is an example of 88. And then from there, you can just see how each year, as the $50,000 goes into this policy, you can see how the cash value increases each year. So in the third year of this policy, she puts 50,000 in, and she can pull more than 50,000 back out. Fourth year, 50,000 in, 53,373 back out. So you're going to see each year that amount that's available to pull back out gets bigger and bigger and bigger, exponentially so. You can see over here the death benefit also, which is not why we do this, but it is definitely a nice little benefit there. All right. Now let me keep showing just some examples of what this looks like over time. So if we look at this from an investment standpoint, let's just say she started this policy, used it to pay off some debt, used it to buy some property, something like that. And then in the 8th year of this policy, she decides she wants to go more passive. So she wants to stop actively working. She's 48 years old, wants to start having her money work for her more. So she goes, let's say, to private money club, and she wants to do some private money lending. So just like Chris was talking about earlier, find somebody to lend her money at, let's say 12%. So let's look at what that looks like. So first off, in the 8th year of this thing, she deposits $48,000 into it, and it grows by $66,000. So if I do the math on that, that's $18,000 in growth, or a 37% cash on cash return. And that's simply $48,000, the $66,000 in growth minus the 48 gives you that 18,000 in growth. So when you take the 18,000 divided by the 48,000, it takes, you put into it, that's a 37% cash on cash return. So let's just stop for a minute here. So if she had never started this policy, and that 150 she had, that 50,000 a year, she was just putting that into a checking account or a savings account at a traditional bank like Wells Fargo. Well, that money would have never started compounding and growing. So in the 8th year, when she puts $50,000 into 48,000 in her savings, well, the money doesn't grow at all because she's earning maybe 1% in a savings account. So this money would not even exist if it wasn't for that. But let's say she wants to go and do the private lending. So what she does is she goes out and she finds a deal to lend on at 12%. So at the end of the day, what happens in the 8th year of this? Well, she had $531,000 in net cash value to lend out, and she ended up making 12% on the private money loan, 37% on that 50 grand within the policy. She paid out 5% to the insurance company for using that money. And so if we do the math on this, her net return that year was 44%. So it's pretty simple. What did she have to do this? Well, she had to start her banking system 8 years prior, and she had to make one change in her life. And that change was, where does her money go first? Does she put her money into somebody else's bank each year, or does she put her money into her banking system each year? She decided 8 years prior to put the money in her banking system. So she grew her money in the 8th year 44%. Had she have not done this, her money would have grown by 12% that year through the private money loan. She would have gave up that other 37%. So we did nothing different except where the money goes first. So you just answer that simple question. What would you rather make, 12% or 44%, especially later on in retirement years? And that's the power of being your own banker.
I love
Any
it.
questions?
Got any questions there? By you doing that, Stephen, you gave me some time to kind of go through, and I had a neat little thing that I figured I would do here, because I've got so many policies that it's sometimes just cool to be able to kind of go back in memory lane and talk about these different policies. So what I just did is I pulled up one of my first properly structured whole life policies that I did when I first met Brent Kessler. And I did this policy in Mexico because I went out to an advanced training that Brent was putting on. And this is going back quite some time ago. And I don't have all the years, but I'm just going to show you kind of this one is 1/25 of 2018. The insurance company, because I live in New York, is Security Mutual. So this is one of my older, the New York life policy is the oldest, but that's a regular whole life. And you already saw how that regular one does. The Security Mutual one is a properly structured whole life. Now, here's the interesting thing. You can't see this, but on all these statements that I have right here, and I kind of highlighted it, but I know it's hard to see, it says the policy loan. There's not one year in this, like here's a loan for 3,078, a loan for 13,000, a loan for 18,559, a loan for 38,000, a loan for 50,000, another loan for 36,000. So what I'm trying to apply is, I'm just going to show you the numbers. I put them all on here, and I put $1,000 a month into this policy, so $12K a year. So 12K is the amount that I put in each year. So we got 1, 2, 3, 4, 5, 6 years of statements here. So 6 times 12,000 times 6. Cumulatively, up to date, I have put in $72,000. Folks, in this policy, I can sincerely tell you this, the New York Life one, I started using the cash value after I realized what this was. But this policy, there's never been a year in my Security Mutual policy that I have not taken a loan. Never a year ever. So I want you to remember that every year I'm doing this, every year I'm going to show you here, all this money, or at least is almost all of it, has been out working for me a second time. And I use this policy to pay off a lot of debt. I use this policy to pay off car loans. This policy was one of the first. Therefore, this policy was one that I used primarily to get out of debt. The fastest way to wealth is through your debts and expenses. And that's what I did with this. But what I figured I would do, since we're on this, is together, why don't we, actually, I missed one number. Why don't we just go through and figure out like the returns on this one? But I also want you to look here. So this is a little bit off, but 466. You can see here, every year that I had this policy, my death benefit has gone up. It went from 391 to 408 to 430 to 476 to 500 to 466, which are not the right numbers because these numbers show the loans coming out. So the death benefit's actually more, but remember when I borrowed the money, and right now I have an outstanding loan as of 1/25/2023, I think it's more now, of 36,880. Tess knows this because she's seen all the loans that I've done from this policy. So I have a loan of 36,000. So my death benefit is supporting that loan. But I just want you to look here, and I want you to look at the cash value growth. 7302, 14, 6, 13, 25, 38, 50, 57. Okay, so that's how it's grown. Some of these numbers are a little off, but what I want to do now is I just kind of want to go through and I want to subtract this one from that one. So let's go through and figure out the net return. 14, and how we do that is I'm going to do this each one. I'm going to take this year, 14,613, subtract the year before, 7302. Okay, so that's my increase that year was 7311. Okay, and then we're just going to keep doing that. And I'm going to do these one by one so you can see how I do this. I'm going to take the 25,724 and I'm going to subtract it from the 14 minus 14,613. Okay, that's 11,111. And we're going to do the same thing. We're going to go one line down. 38,206 minus 25,724. 12,482. How many years, Stephen, did it take me to break even? 3, magic number. So I'm going to draw a big old fat line here. 3 years. 3 years, I hit my efficiency zone in this policy, which means I put 12 in and I got more than 12 that I take out. Okay, so now I'm in the money is what I would like to call that. So let's keep going. Let's see, 50,676 minus 38,206. And what you'll see is this number, whoops, see, I missed, I was doing this really quick when Stephen was doing it, so I think I missed dividends because they break it down differently. 38,206, 12,470. It's probably more because there's no way it would be less than the prior year. Either one of two things happened. Either I put less money in because, yeah, the math isn't working, but I was just trying to show you that every single year this goes up. And I kind of just did this on the fly, so bear with me, but every single year I had money in this policy, I took money out. And I never stopped growing, even though all the money came out. So again, we're just continuously hitting the numbers over and over on the machine, the policy, over and over and over again. I want to answer Gold's question here. We always mention being careful to not go over the limit and make it a MEC. Do you think you could make a video explaining exactly what this limit is? I know it goes higher and changes each year, and the implications of if you MEC the policy, what would the taxes look like? Like, would you pay on the interest now, and when you borrow the money as a percentage is taxed? So I could. So Gold, I'll tell you why I haven't done that video. I will never build a policy to MEC. And if a client accidentally MECs one of their policies with us, we get notified and we will call and fix the problem. We've had to do that a couple of times. So I haven't done a video on it because really we don't want people to MEC their policies. And we don't build MECs. The only scenario where we may build a MEC policy would be if it's owned by a foundation. Like a foundation is, is tax-free by nature. So that's a good way to look at it. I mean, I could do that video. I don't know how valuable it would be because first off, clients don't need to know MEC rules and that. Every person's MEC limit based on the premiums they're going to put in, based on the dump in, their age, their rating, it's going to be different. So it's almost like, it'd be like taking a rifle and trying to shoot a mosquito. That'd be about what it'd be like. I'm never going to hit that mosquito. As good of a marksman as somebody would be, they're not going to hit that mosquito because the mosquito is constantly moving. It's such a small little thing. So I wanted to hit that, but I just want you also to know that when we design these policies, every one of these policies, none of them are a MEC. We're not going to design a MEC policy because if we do, all the gains, so like, 470, 482, every gain that you have would all be taxable. It'd be taxed just like a retirement account would be when you took the money out. And you don't want to deal with that. So therefore, we don't do that. Stephen showed a dump. You showed a dump in on yours, right?
Yes.
All right. So Stephen showed a dump in. So you can see the impact. When you front load a policy and you dump money in, it makes a huge difference. Okay. A huge difference. And I just so happen to have one of my policies right here, my most current Guardian policy. And I have this policy owned by my family trust. This policy was set up so that my family trust had a death benefit that would pay down to a foundation. So when I die, $750,000, it's actually I won't die anytime soon. It'll be over $1 million. Let's see, if I live till, how old does everybody think I'm going to live till? If I stay with the stress that I'm at, probably 85. So at 85, I'd have a death benefit of about $1.35 million, but it started at 750. So this policy is pretty unique. And what I like about this one is when we look at cumulative, like when we're adding up the total amount we put in and trying to figure out where does the policy break even. So the interesting thing is we've over time gotten really stinking good at designing these policies, kind of like the one Stephen just showed you. That one was really efficient, more efficient than the one that I just put up on the screen, which was my first policy. But now we get super efficient with these. And I'm just going to give you the guys the numbers. This policy, my dump in, these are kind of weird numbers. This is the dump in, 43,000. My premium is 23,860. Okay, this is my normal premium, and that was the dump in. So this policy, if I do the math, I broke even on this policy about midway through the 4th year, total break even, not efficiency zone. So it took me essentially 4 years. That's the marathon in this policy. It took me 4 years to get back every penny in every penny in premium that I put into the policy, including the dump in. 4 years. That's what it took me. Pretty darn good. But my efficiency, so the first year I put in 43. The first year, okay, we'll just do this. The first year, my cash value was 37,861. The second year, my cash value is 62,462. So let's just do the math. So now we got the cash value for year 1 and year 2. If we subtract them, we'll figure out, did I make more than what I put in of 23,860? So 62, I've never done this, folks. I've never even looked at this. It's kind of funny as you start doing this. This is like my 10th policy. You just stop looking at all the specifics that you do the first time because you just know how the process works. Wow, look at that. Never looked at this one. That's pretty impressive. So it took, essentially by the end of the second year, for the rest of my life, I will take out more than I put in. Because if you take 62,000 minus 37,000, you have 24,602 or 601. And if I subtract the premium, 23,860, the difference is my net gain. And it took me 2 years to get there on this policy, 2 years. So what happens when I go year 3, 4, 5, 6? Every year that number will go up. Every year I'll make more than I did the prior year, and that will never stop.
The one thing I'll clarify, just so there's no confusion, we are talking about the annual net return when you deposit money in. So the cumulative amount you put into the policy is going to be later, probably you're like 7 or 8.
This was the cumulative, Stephen.
Okay.
That's what, here, let me.
Most policies, we're going to
most don't do that.
Given like year 7 or 8.
Yeah, I'll give you the cumulative because luckily Guardian does this. So cumulative outlay by the 5th year, I put in 139,301. So this was my cumulative outlay, and I'm glad you brought that up. And then my cash value that year was 140,181. So this is my cash value. This is my cumulative premium. So this was technically the 5th year. Okay, so by year 5, after I get the dividend, I broke even cumulatively. This over here was the cash on cash return. That's the efficiency zone. So we're talking 2 different things. And I want to preface, folks, and Stephen, this is probably where you were going. We don't give a shit about this. We don't care about this. And some of you are probably confused. Is anyone confused as to why we wouldn't care about a cumulative return? Anyone know? Or does anyone want me to explain that? So I don't care about a cumulative return because every year I put money in the policy, I can take money out. And when I take money out, I don't affect the interest, the compounding effect of my policy. So why would it matter when my policy breaks even cumulative? And I know a lot of people, before they understand what it is we teach, they get really hung up on that. They're like, oh, this thing took 7 years, the cumulative, to break even. And we're like, no. It took 7 years to break even. If you put money into the policy and you just left it in the policy, it took 7 years. How many of you think we put money in these policies and just leave it sit there for 7 years? Never. It's not what we teach. We put money into the policy and we find a way to get that money out of the policy in the form of a loan, working for us a second time. I did that with a loan to Mary Bobber, but remember in that security mutual policy, I paid off debts. So I would take a loan from the policy and I would pay off a credit card. If the credit card was 20%, I take the amount I gave the credit card, call it $100 a month, and I put it back into my policy as a loan repayment. I already showed you the math on what that does. And I do that over and over. When all my debts are gone and I don't need any more cars in the garage, because those are all risk-free returns, which is kind of how I want to finish this thing up. Me and Stephen had a pretty awesome conversation this morning about why I use my policies for the things that I do when I can make more money. And I'm going to hit that. It's called risk mitigation. And I'm a very risk-averse person. I don't like risk. But so some of you are probably still hung up on that cumulative return. Now, if you could put money into something, take the money out and make it go out and earn for you a second time and still earn interest on one, what would be the return you would care about? Would it be the cumulative return, which in most cases this one took 5 years, like I showed you? Would it be that, or would it be this? It would be the cash on cash return. Because every dollar I put in, each year I'm putting 23,860 into the policy. And every year I know I'm going to find a way to get that money out. So in the second year, in my policy here, I'm going to find a way to lend $62,000 out. I'm going to use that money. And when I use that money, I can earn a return. Let's call it 12%. And if I make 12 and it costs me 5, what's my net? Well, you can do the math. But the net also is this plus what the policy earned. So let's go 3 years, just so that I can kind of give you that number. This is why, like a lot of people, if they don't understand this, why I sometimes can maybe be, I don't know, some people would just say I'm an asshole. And that's okay. Maybe I am an asshole. Or maybe I've just gone so far down this rabbit hole that I understand it at such a level that there's not a person out there that could ever tell me this doesn't work. I will go to the grave. They literally are going to have to slit my throat so that I can't keep talking and bitching them out that they're wrong and I'm right. And listen, like, you can call it arrogance, you can call it whatever it is. It's called mastery. It's called the 10,000 hour rule. You know, when you take that challenge with Earl Nightingale's The Strangest Secret in the World, one of the things you'll realize is you need a worthy idea. You need to know who you want to be, what you want to do. And I'll tell you something, that changes a lot, but I can tell you this, and this is a bold statement. I don't think Steven's ever heard me say this. I can tell you, I am the #1 money mentor in the world when it comes to infinite banking. I'm going to tell you that right now. Now, that may not be true, but you can't tell me differently. And you can't tell me differently because I will tell you that you can put anybody in front of me, any financial advisor, any CFA, CFP, whatever, CPA, put anyone in front of me. Mathematically, I will prove them wrong that this concept works every single time because it's just math. And as long as you figure the math out and you got cool people like Craig Yenny who can build calculators that actually show it, then nobody can prove you wrong. So think as if. I think as if I am the best in the world. Whether I am or not, it doesn't matter. I believe I am. So because of that, I understand this at such a high level that no one can tell me that cumulative return matters when you use this for the process. So let's go one more round here, and I want to just show you. So we're going to go 87,317.
Chris, as Santa's #1 IBC elf, I can agree with your comment, just so you know.
All right. So there we go. We've got confirmation from IBC's #1 elf. That's quite the title. Much better than the dude's title. But anyway, there we go. All right. So I made 24,000 net. Okay. The difference between third year and second year's cash value. Everybody following that? So 24,000. Now we got to subtract the amount I put in. So that's 23,000. So we do that. 23,860, 995. So I made $995 net. Okay, that's how much I made. So now if I want to know how much money my policy actually made me after those terrible expensive costs of insurance, after those terrible commissions were paid out to the agent, which, by the way, folks, I said it earlier, I'll say it again. To build a policy like what I'm showing you requires the agent, us, or your broke-ass brother-in-law, to take a 90% reduction in their commission. I'd have to give up 90% of my commission so you could have a policy like this. Does that make sense? We always design every policy to give up 60 to 90%. Why don't we do all of them to be 90%? Because not all of them can be built that way. That's why. Not because we don't want to, but just age, health, the amount of money someone's putting in, we can't build them all that way. Every design is unique to that person. So 995 divided into 23,860 gives me my cash on cash return. In the third year, my cash on cash return is 4.2%. Everybody understand that? Cash on cash return, 4.2%. So if I took, in the second year, if I took 62,000 out and I lent it out at 12%, and I knew my net return on the policy was 4.2, then I know I could go in here and I could say I made 12 on that side, plus I made 4.2%. So I made 16.2% on my money, but the insurance company charges me interest. And I can't remember what Guardian charges. We don't do a lot of policies with Guardian. I only did a Guardian policy because, hey, I feel like, if I'm going to go to the ice cream store, I should just try all the flavors. If we're going to use Guardian for clients, I should try a Guardian policy myself. Doesn't that make sense? Oh, right here. Look at this. Interest on the policy loans is 5%. They got a couple options. You can do 5%, or fixed loan interest rate will be decreased to 3.5. It gets complicated. So let's just call it 5%. Okay, that makes it easy. So Guardian in this one is going to take back 5% of that math. So what is my return? 16 minus 5. So it's still 9.2%. Wow. Some of you would sit there and say, wait a second, Chris, you only made 4.2 in it, and it cost you 5 if you were just doing it from the policy side. You'd say I lost money. I'm only 3 years in. If I go 4 and 5 and 6 years, it gets better and better. So that's the marathon. You're going to listen. Here's the bad news. On the radio show, they're like, hey, listen, that's all sounds great, but what are the bad things? And I said, great, here's the bad things. That policy I just told you about, I put in 43,000 in the first year and I only had 37,000 to use. That's bad. I put 43 in and I only have 37,000 I can use. That's awful, right? And they didn't really know what to say. And some of them were kind of just nodding their heads, like some of you are right now. You're just nodding your heads. And then I said to him, okay, so how many people do you know that go to the bank and deposit $43,860? And then before the year's done, they rush back into the bank and they take all $43,860 out just to say, I told you I could. How many people do you know that do that? None. I've never met anybody that does that. So does it really matter if I put 43,000 in that I only have 37,000 to use? Absolutely not. Not in my world. Now, somebody I'm sure out there would say, oh, it matters. You're not my client. Guess what? If that matters to you, if that negative, that worst case scenario that you put 43 in and you only have 37,000 available in the first year, if that's a big deal to you, I got great news for you. Don't do this. Don't call me. Don't watch the video. Well, you should watch the video to learn, but we can't help you. That's worst case scenario number one. Worst case scenario number two, I can't get issued. Something happens. This cold turns into pneumonia, which then cripples me. I don't want to put that into the universe, but let's just try to pick on myself. I can no longer get insurance. So now I want another policy. I can't get one, but I have a daughter, I have a wife, I have a mom, I have an insurable interest in all of those. I have executives in my company. I have insurable interest in all those. I could start doing policies on each one of those people and I could own them all. So that's another, one that reduces it. And some people would say, yeah, but in a bank account, I can set a bank account up and I can put money in and then I can not put money in the next year. I don't have to put. What happens, Chris, if I start this policy at 23,860 and next year I lose my job, next year business sucks, next year I can't make a deposit of $23,860. Here's the good news. If I make it through one full year in the policy, this policy, I could reduce that down to, well, it's about $5,200. So I can go down, my minimum is $5,200. And if I don't have $5,200, I can do it monthly, which means I could go and I could make deposits of $300 or $433 a month. Worst case scenario, let's say I don't even have $433 a month. What would I do? I could sell this policy. There are people and institutions that will buy every whole life policy that you ever buy if it's designed this way. These are like gold. We're not sitting here. Someone on WTF this morning said, oh, we're slinging gold, right? We're selling gold bars. Is that what he said, Stephen? We're selling gold bars? I think it's what he said.
selling gold bars. I don't know what that's all about.
But he said that. He was just Mr. Stinky, I think his name was. But he said we were selling gold bars. Well, you know what? I got something better than gold bars. I got this whole life policy, which every year goes up in value. Gold goes up, goes down, goes up, go down. This never goes anywhere but up. So next year, I can sell it for more. The year after, I can sell it for more. The year after, I can sell it for more. There's never a time I can't sell this policy for more money. Gold bars don't work that way. And if I die, money goes to my beneficiary. So I sometimes have a hard time talking all about the negatives, but I mean, the negatives are just that. The negatives, if they affect you, you shouldn't be doing this. And, or you just don't understand the alternative options, which would be finding somebody else to insure. So what other questions do we got? 5,200 the minute. Yeah, that's the base. Yep. And it's a little bit more than that. It's like 52 and change. The way this illustration breaks it down, it's weird.
I think the last thing we can kind of end on, Chris, is what we were talking about this morning, where, the greatest way to wealth is by, keeping all of your debts and expenses, and interest that gets bled out. And we were talking, my cousin right now he's an investor in Private Money Club. He's owns a lot of real estate, but he's currently buying a new Range Rover that's $130,000. So he needs 130 grand. So he can either finance it through Range Rover at close to 9%, or he can use his policy to buy the Range Rover, which he has the money in it to do that. And so the question became, does he take the 130,000 and invest it with one of his borrowers at 15% and finance the Range Rover at 9%? And over 6 years, what would be better financially to do? And when we ran the math through all of our software, it actually, borrowing the money at 9% and investing it at 15 actually came out slightly better financially. However, it's not taking into account still all that money that's being bled out to the finance company, but more importantly, there's risk involved. So maybe if you just want to talk a little bit about that, Chris. I love the way you had put it.
I just want to ask everybody, the simplest question would be, would you rather earn 9 or 15%? Would anyone like to earn, would you rather earn 9 or 15? Just put the number in the chat. I almost bet if everybody answered, they'd all say 15%, right?
Right.
Okay. You want my answer? It depends, but I will always take the 9%. But what does it depend on? Well, let's use Brent's scenario with this Range Rover. He's going to go out and buy a Range Rover, and he's going to take a car loan at 9%. Okay, and he's going to pay the bank monthly payments every single month on that Range Rover, which means they're going to get the interest. But he doesn't care about that because he's going to go invest the money with the Fullers at 15%. Okay, now let me ask you, is there risk with investing money? Is there risk with lending money? Yeah, there's risk, right? You can mitigate that risk, but there's always a level of risk. That's why it's called an investment. And I love when people say, oh, you're investing money in a whole life. You can't invest money in a whole life. A whole life isn't an investment. It's a guaranteed. So it's not an investment. But let me come back over here to this loan. All of you said 15% because it's a bigger number. And that's what your mind has been trained to think. I said 9%, but I also said I've been down this rabbit hole a little too long. And I also told you I'm risk averse. So let's just run the math here, okay? So let's say a Range Rover is 100 grand. Steven, can you do me a favor? Can you pull up an auto loan calculator and just figure out what the payment would be on that? And I'll do the rest. So the Range Rover is 100 grand, and we're going to lend the money out at 15%. So that's $15,000 divided by 12. Let's just do this monthly, $1,250. Brent's going to earn $1,250. What's the payment going to be on this car at 9%, Steven?
I mean, I have the actual purchase sheet. Let me just pull it up.
Now let's just do 100. And
right.
Stick around, folks. I want to give you the challenge. Do a 5-year loan. We'll just do 5 years.
So you got to do the math. The amount financed is $95,737, okay, and that's with a $35,000 down payment.
So we lost the opportunity of earning money on 35. We're not even going to factor the 30. So he lost the earning potential of that 35 grand because it's sitting in a car that depreciates. So let's just do 95,737. What's the monthly payment on that?
$1,726.44, and that's for 72 months.
The numbers are just going to keep getting better and better. All right, so he's going to basically lend the $95,000 to the Fullers at 15%, earn $1,196. And again, I can't not see this 35 grand that's lost. And he's going to pay $1,726.44 for 76. But after the 76 or 72 months, after the 72 months, the car's paid for, and he's still getting the 15% if he kept the money with the Fullers. So all of you said you'd rather earn 15%. I told you I'd rather earn 9, because here's how I would do this. I would take the $95,000. Forget about the 35. It's going to confuse me. I would take that and I would buy the car. There's my Range Rover. I bought the Range Rover with cash value loan. Okay, that's a loan from the cash value. And that's going to cost me 5%. I would then do the exact same truth in lending. I would take this $1,726. I would set up a bill pay, and that bill pay would cut me a check every single month to Chris Naugle for $1,726.44 a month. So let's do the math. 1720. This is how I do every vehicle, folks. I have lots of videos on this. Times 72 months. At the end of it, I will have gotten $124,303 back. Okay, that's how much money over 72 months. This is how much he's going to pay the car dealer for that vehicle, and he's not going to earn that over here. I don't think he's going to earn back the way he's doing it. Times 72. He's going to earn back 86,163 of that minus 124,303. So he's got a deficit of 38,139, well, plus the 35 grand. So here's the reason, folks. So 124,303, and I know we're going long here, just stay with me. Essentially, most people would just take, here's how much I paid back to myself in checks, bill pays, for the vehicle that I paid $95,000 for. I paid back $124,000, of which $28,566 is interest. Okay, that's the interest that I would have paid back. So that's the interest on $95,737. So really it's 29%, if I'm doing it right. But again, none of that matters. I'm going too deep because I'm getting in my math brain. All I want you to understand is how much risk did I take to make 9% for buying the vehicle? I bought the vehicle with a loan from my policy. Every month I made the same payment he is going to make to the car finance company, but I made it back to my policy. The numbers just keep getting better and better. That's why I'm nerding out, because like everything I'm showing you, it's way better than this, because I don't pay the 5% interest. Like I don't pay this 5% interest to the insurance company. Every month I'm paying $17.26 is reducing the loan, meaning I'm paying less and less. But it still is a zero risk loan because it's a loan to myself. And I am not going to steal from my bank. I am not going to not make payments, because I would make payments to the car finance company, just like Brent's going to make payments to the car finance company. I'm going to do the same thing. There will never be a day that I won't pay myself back. Why? Because I want the 17, because I'm call it greed. I want $1,726. I don't want their bank to have it. I want my bank to have it. And every payment I make back to my policy, I have $1,726 available to me the next day. Plus, I took no risk. Even if we pencil the math on the 15%, which is fine. Like, listen, to each their own if you want to do it this way. Even if we pencil the math, there's still risk involved. And if something goes wrong, if the person you lend the money to, something doesn't happen, they pay you less, they change the 15% during the 72 months, like maybe they can no longer pay you 15 and now it's 10 because interest rates go down. Do you see? There's so many things that can go wrong or change over here. Forget about them ever not paying you, but you never can bank on everything being as it is. But over here, in this world that I live in, I control 100% of this. People ask me all the time. They ask me all the time, Chris, you're always buying your mortgages out. Like I recently just bought 2 mortgages out from Alden State Bank on 2 of my rentals. I paid the mortgages off to the bank. How much was the interest rate on the bank? 6%. How much am I paying myself back from those property companies? 6%. People are like, that's stupid. Why would you do that? 6%? Like, why wouldn't you lend that money out? You can make 14, 12, 15% on that money. It's the same thing every time. By me paying those mortgages off, I'm no longer a slave to the bank. The bank can no longer call me and ask me for those stupid effing personal financial statements that they want each and every single year. They can no longer tell me that I didn't pay my property taxes on time. They can no longer tell me that the homeowner's insurance isn't suitable for their new guidelines. I don't answer to the bank anymore because I took back control of my money. I took back the banking function in my life. 6% versus 14. Every one of you would take the 14 until you start looking at the things and the reasons why you shouldn't always take the higher return. Listen, folks, you'll get a lot further ahead in life hitting base hits. If you swing for the fences all the time, you're going to strike out a lot. I tell people all the time, I'm a professional nickel and penny picker-upper. That's what I do. Consistently and persistently. Picking up nickels and pennies, nickels and pennies, nickels and pennies. And I've made a career out of it. I've made a life out of it. And I've gotten very wealthy doing that. And I've gotten very wealthy with a hell of a lot less risk. Is it sexy? No. Is the stuff I go out there and I brag about all the time? No. But does it work? Yes. So I hope you all learned something from Brent's example here. I'm not saying one is wrong. I'm just saying everybody wanted the 15 and I wanted the 9 because I'm focused on risk versus return. That's it.
In worst case, in a few years, financially, something devastating happens. Guess what? There's nobody there with a tow truck repo in your car because you're in control. You're the bank. And so you still have the car, even though you're broke. You're driving a Range Rover. So it's all good.
So folks, as we kind of get to the end, what I would love to do right now is I'd love to challenge all of you. The same challenge I've challenged each one of my team. And the same challenge I'm going to challenge all 104 of you. This is a 30-day commitment. You can't cheat yourself on this. Please, if you take this challenge today, I want you to literally, you remember back in the day, you would cut your palm and someone else would cut their palm and that was your bond. Or then, when AIDS came out, you just spit in your hand and that was your bond. And then they were like, oh, then COVID came out. And I don't know what the kids do nowadays to have that bond, but whatever that is, you're making that bond, that commitment to me today, to me, to Stephen, and to all your fellow campfirers here. Everybody here is around the campfire. How many of you are going to take this challenge and not miss a single day, no matter what? It's a 28-minute fist pumps these days. Well, next year, that'll be something different because there'll be some new virus that comes out that when you pump fists, you're going to get a virus that kills you, and you're going to need a vaccine for that one too. All right. Anyway, how many of you? That's it? Just like one? Only one person wants to change your mindset and your life forever? Drew's already doing it. Felix? Okay, good. Here's what it is. Every day, I need you to carve out time for 28 minutes. And here's the video you're going to watch. I want you to write this down. This is the video.
I'd like to tell you about
The Strangest Secret in the World by Earl Nightingale. Now, some of you, Tess put it in the chat, some of you have already seen this. I've seen this more times than I can count, but I'm still doing the 30-day. Now, every single day you're going to watch this video, start to finish, 28 minutes. Or sorry, 31, but there's some fluff at the end. 31 minutes. And every single day, you're going to find me on Facebook or YouTube or Instagram, whatever your channel is, and you're going to DM me. Or I don't even care if you don't DM me. It doesn't matter. If you DM yourself, I want you to write down one thing that you took out of that 31-minute session each day, every day. And if you duplicate yourself, it's okay. I do it all the time. If you know you're like, oh crap, I already said that. That's good. If it's the first thing that comes to you, that's what you write down. For 30 days, if you take this challenge, I promise you, the rest of your life will be more successful than it is, financially, emotionally, and you'll just be a happier freaking person. 30 days is all it takes. So if you guys did that challenge, I want to know every day what your takeaway is. So please find a way to send that to me. Okay, that's the challenge. For those of you that know, you know. For those of you that don't, you're in for a wild ride. With that being said, folks, that wraps another week of the Wealth Webinar. Thank you for joining us. Thank you for letting me talk a lot about my policies and why I do the things I do. And hopefully for some of you, you'll take that one change, that one step, and you will then change where your money goes and start taking back the banking functions in your life so that you don't have to answer to their bank. Your bank is the only one you'll ever answer to. Thanks, everybody, and have a Merry Christmas and a Happy Holiday. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.